Welcome to those of you that are here just logging in. Of course, we're going to give it a minute or two here to allow that to run its course. I'm looking at the check-ins here. I see a number of clients and friends and that are all eager to meet Mr. Bruce Norris and see what he has to say about our local market here. We had about 200 people or so register for the webinar, Bruce, just so you have some idea. And we had at our live event last week, we had close to 300 people in the room. So people are eager for this information.
It reminds me of years ago, I spoke at the Apartment Owners Association, and there was a room full of 300 people, plus everybody was against the wall. And I was looking out going, you guys are either really excited or really scared.
Right. Okay, so we'll get started. Again, welcome all of you to our live webinar. I am Chris German with the Apartment Dealer. With us today, we have Mr. Bruce Norris. Now, if you're unfamiliar with Bruce and his work, Bruce now for more than 3 decades, not only has been a real estate investor, educator, hard money lender, developer, builder, but he's most widely probably known, and why I imagine most of you are here today, at his gift of taking a look at the market analytics and dissecting from multiple channels what is the underlying thread, what can they tell us about what is to come, learning from what has been, what's happening in the present, of course. And he's done this not once, not twice, not 3 times, but continues to do so. So kind of eerie, in fact, that in 2019, Bruce and I were at a live event together, October of 2019. And Bruce from the stage asked the question, well, what would happen if there was some type of black swan, some type of anomaly that came into the market? Well, interestingly enough, in 2020, we had COVID. And so, of course, Bruce wasn't thinking COVID, but the question still remained of how would the market react? And we saw how the market reacted, how the Fed reacted. And really what has spawned what we are here today in terms of the market cycles. So Bruce, all the way from Florida, I know that you couldn't be at our live Apartment Owners Educational Luncheon last week. As I mentioned, we had close to 300 people there, many of which are looking forward to this webinar to bring what you have to say and couple it with the information that was shared at our event. And I thank you for taking some time with us this morning, all the way from Florida.
Chris, thanks so much for having me. I'm going to take you back to the beginning of some of these interesting things that I experienced. In 2009, there was a gentleman named Bill Richards. He was the senior client manager for UBS, and he hosted a quarterly meeting with the top 10 hedge funds in the world. And in the January meeting, the first quarter, the guest presenter was Paul Volcker. On the second quarterly meeting, it was Bruce Norris, which is kind of funny because everyone knows Paul Volcker and who in the heck is Bruce Norris. So why was I asked to speak to the 10 biggest hedge funds in a 3-hour dinner and talk to them about what I had seen? Go to the next slide. I've paid attention to this chart for years and years. And in 2006, I wrote a report called The California Crash. And I got a chance to get invited by John Burns, who has a consulting business. And he had a builder consultant that was from UBS debate me in front of the California builders. So this was in 2006, a very happy year for real estate. What they didn't know is I had sold about 100 properties that I owned just a few months before that to exit. And a few years later, when the market bottomed, I would begin accumulating over 700 other ones. So that's the importance of understanding when to do something. Go to the next slide, please. So this is the report that I wrote, and predicting that prices would go down by 50%. What's really hard about writing a report like that is it hasn't occurred yet, and you write that report in 2006. What's the mood in 2006? Everybody loves real estate. So it's very hard to believe that what you're saying is true, but how important it is to understand that there's a process to know, even before a builder, what's inevitably coming. The builders were euphoric because they had such recent information, as in if they put a house up for sale, everybody wanted it. A year later, no one wanted it. And so it was a kind of a stark thing for them to realize that this was in fact going to turn really ugly. At that, after that dinner, I was offered several $1 billion from hedge funds to invest their money, and I passed. And Chris, like you, I have a passion, and I have a passion to deal with people that are families, the men and let's say that are raising families and kind of started where I started. That was my passion, and I knew it. And I didn't want to take a couple $1 billion from UBS, but we got put on the map. And the next morning, I got a call from Goldman Sachs. And one of the reasons I don't like Wall Street is their attitude. So the first thing the Goldman Sachs guy said to me, now he just called me. He said, "Why am I talking to you with that kind of tone?" I said, "I don't know, pal." I said, "You called me. What do you want?" He said, "Well, we heard what you said last night to UBS, and we completely disagree." I said, "Great." I said, "Why don't you ask a couple questions and I'll answer them. If you're not happy, hang up." He said, "Okay." So he asked the two questions I knew were coming. I explained to him why his thought process was wrong. There was a pause. And he said, "My God, you just saved me $1 billion." He said, "Would you like to be our consultant?" I said, "No, but thanks for calling." And that was quite an interesting little piece of my life. But how did I even get interested in looking at when to look at real estate charts and what's next? Go to the next slide, Joe. So in 1988, I had a chance to buy 50 building lots. Now take a look at that price chart. 50 building lots in 1988 in a prime area around lakes should have been really busy, and busy it was everywhere else, but these 50 lots. And I started looking at them going, oh my gosh, one guy must own these. There's no way 50 individual people would not build on these lots. So one guy owns them. And sure enough, it was the Bass brothers. And so make it long story short, I made a deal to buy those lots. In 6 months, the hardest 6 months I ever worked, I made $1 million selling those lots. And then in 1989, bringing that euphoria and the new money and all that, I bought 7 custom home lots, and I had partners, and we built 7 custom homes at exactly the wrong time. We got done with them in June of 1990. I ran a full-page ad in the newspaper in Palm Springs, and not one phone call. Over the next 2 years, I would stand in front of $21,000 a month payments and take the hit on every one of those houses. So everybody got their money back. Everybody's credit was perfectly intact. But I learned a valuable lesson that real estate could hurt you. And then in 95, I had something interesting happen. Next slide. Aaron graduated from high school, and I bought him a Honda Civic for $15,700. And 2 days later, bought a house in California in Riverside for $13,300. And I just had that aha moment. I go, wow, I've been doing this for 15 years, and I have no idea what makes prices move. I have no clue. Here in 89, I thought I was making the right decision, and prices went down and hurt me. And now I'm buying a house for less than a car. How does that happen? And so I thought, you know what? I'm going to try to get to the bottom of it. And the first thing I did was try to figure out if there's somebody else that figured it out. So I went into the library, and they had microfilm where you could say, show me every magazine article that has to do with real estate prices. And so I read every magazine article and every newspaper article for 25 years, from 1970 to 95, trying to find the author that said, this is what's going to occur. I never found that person. And so I said, okay, I'm going to see if I can do it myself. So for the next 18 months, I went into multiple libraries all over California, and I went with a pad. And if there was a topic I didn't know, I mean, if I didn't have the data for, I literally hand wrote it from 1970 to 95 every year, and then created charts for that. I drew no conclusions until I had all these charts. Now, keep in mind, I had charts that ultimately I would discard because they didn't stick, but I didn't know that at the time. So I had lots of categories. I went to Maui on a vacation. I put these charts, I couldn't overlay in a computer because I didn't know how to do that. So I laid them on the floor, and I had yardsticks, and there were 2 boom and bust cycles already in California. And so I said, okay, let's take a look at a boom cycle. And I played with the charts, and what I was looking for was a sequence. It had to happen every time. And I thought, wow, I see it. And I wasn't thinking of writing a report. That was the last thing on my mind. What I wanted to know was where to put Bruce Norris's dough. Mm-hmm. And then when I got to the bottom of this, I said, okay, I think I will write something. And it was mostly for my dad, to be honest with you. Next chart, or next slide. So I write this report. This comes out January of 97, why real estate prices will double in the next 8 years. Now, when you write a pleasant title report, it's like received with a hug. They don't, they think you're crazy, but they still like that you showed up. When you write a crash report in the middle of a boom, no, that's not the reception. So this was happily received, and then go to the next slide. That's what happened to prices. It gradually kept going up and up and up, and after 8 years, it kept going up some more. And I started to get concerned, and that's when I realized something was amiss. And in 2007, 2006, we interviewed a lender in front of an audience of hundreds of people. And Chris, you'll appreciate this question. I thought it was going to be a 15, 20-minute interview. It was a 1-question interview because I got my information right away. First question I asked was, stated income loans, where does the stated income number come from? And she said, oh, we just make it up. And I just thought, okay, I now get it. The whole thing is fraudulent, and you're so arrogant, you don't even mind saying we commit a felony on every loan. So, okay, I got it. So that was after the California crash was already written, because the numbers were already skewed, but that created a big problem. Go to the next slide. So California crash again, next. So prices went down, and then, they stayed down. They stayed down until about 2012. In 2012, I really sort of became devil's advocate. I thought, you know what? Maybe California is done. And I need to understand that. If we're going to stay at the bottom, which is mimicking the national price, I need to understand that. And so I really played devil's advocate in this report, basically to answer the question, should I go all in or should I fold? And the answer was all in. As a hard money lender, we created an 8-year loan for investors, and we told them, go all in. Next chart. So in 2012 for the next 8 years, off to the races until, Chris, you talked about the report, where once again, we had overdone it again, or really close to it. And then the pandemic, oh my goodness, that created unbelievable price changes and urgency. And so that's really amazing at what happened. Next slide. Inside of that time frame where prices went up in 2017, we had a title of this, 2% mortgage rates and 40 trillion in debt. It was actually a projection for 10 years on the debt. And I said that in sometime in that stretch of time, we would have a mortgage rate that started with a 2. Now, once again, think about all these titles that I've put my name on. That's scary stuff, hard to believe, and yet they've come true. So I'm saying that so you understand where I'm coming from. What I'm most concerned about now that, of course, I have a reputation and people that listen to me, that's very meaningful. Well, matter of fact, when we gave the California crash, the first probably half hour I devoted to do not just take my word for this, analyze it, challenge it. That didn't happen. People were calling at the first break. So it was really true. So I'm going to talk a little bit about what I think we're going to be facing here pretty soon in the next couple of minutes. And then we do have an all-day event to talk about it at length. So go to the next slide, Joey. This is the moodometer that's what I call it. This is the percentage of the median income it would take to buy a single family home in California with a 20% down. So that's a really interesting chart. Why do I call it a moodometer? Because to me, it ranks the mood of the participant. If you look at the gold line, that's the capacity of the participant. The capacity is very high. You got it there. You have reached it in 80, 89, 06, and in 2022. Huge capacity. As a group, how do you get there? How do you get to such a high level as a group? Well, if you had anything for sale in 2021, you know what happened. You couldn't wait for something that you own get put up for sale because God only knows what it'd go for. You know you'd have 20 offers in the first 4 hours, and you'd get a price that you'd never dreamed of. Well, why? Because the mood of the participant was off the charts, and they had probably tried to buy 10 other homes and failed. The pressure was on, and then all of a sudden it's not. So take a look at this chart and tell me, how long do you stay at the gold mood? Not really very long. And there's another level of mood, and that has a mathematical certainty to it. So take a look at from 2006 on, how many years were we over a 40% mood, if you will, where the median price to buy a home in a monthly cost was under 40% most of the time. So let's go to a 40% chart now. We're sitting here looking at, we're almost at 70%. But what if things went back to normal at today's interest rates? Go to the next slide. If you had a 6% mortgage rate, your median price would go from 735 to 465. Go back, Joey, to the moodometer. How often does that happen where the mood descends and goes back to normal? Every time. So go to the next two slides at the end, Joey. So really, this is an interesting question that I'm really still pondering and doing research. So what's next? I feel like we have a lost decade in front of us, or we better have 1% interest rates.
And the 1%, it would be the only saving grace.
Well, because if you don't have that, and okay, go back to the moodometer. How often do you visit this gold line? Once every 15 years?
Right.
So if you think you're going to get back to the gold line and euphoria in 2, 3, 4, no, never's happened. So, you know, we've been very blessed with an interest rate. When I joined as an investor in 1981, I owned a home free and clear in Riverside, and to my wife's consternation, I refinanced it to become an investor at 17.5 fixed. Ever since then, that chart has gradually gone down, as you know, all the way to about 2.5. Well, that's allowed this price craziness to happen. And so what's next? It'll be very interesting to see. Now, that doesn't mean there's not mitigating factors, because we're already feeling the benefit of that. But one thing I understand about what happens in a downturn, and by the way, this is the best cheat sheet there is. How smart do you have to be to look at this gold line approach and go, you know, I think if you were in the mood to get out of something near the top, that would be it. And as the mood descends, here's what's really interesting about a mood. So let's say in 2009 and 10 and 11 and 12, Real estate's cheaper than it's ever been. How's the volume of sales? It stunk so bad that we had to bribe somebody with $8,000 to buy one that was discounted 60% from 2006. In 2006, you didn't have to bribe anybody to buy anything. So a $365,000 Moreno Valley house in 2006, we were buying at 65 grand in 2009. And why were we able to buy it? Because there wasn't a bidder for 66. So this chart basically is a great cheat sheet. It judges the mood of the participant.
I'm sure the mood of those watching is changing slightly as well as we're going through this data. So I'm chomping at the bit with a few questions here, but I know that the participants also have questions. So Bruce, I'm going to ask you a couple questions here. While I do that, for you, the viewers, if you have a question for Bruce or I, if you hover down at the bottom of your window there, you'll see Q&A. Go ahead and click there and submit a question. We're going to get through a handful of these while Bruce is with us. So Matt, if you could bring up the article that we have, I'd like to start with that. You know, as I mentioned, we had our apartment owners educational luncheon where we go through our own set of charts, if you will, tracking, hey, what's happened with regards to vacancy, price per unit, cap rate over time. And CoStar Group, which their sole responsibility is to sell analytics to brokers like I. They have no horse in the race, whether apartment owners buy, sell, trade. Matt, we're not seeing the article. They just released this article at the beginning of the week where they're tracking, because they track nationwide. This is not just solely California, tracking apartment sale values. Well, apartments have lost value now for the last 8 straight months. And that's directly tied to the rise in interest rates. So here we go here. Biggest price drop since the Great Recession even deepens. And again, this is nationwide. So we haven't felt as significant in decline in values as other parts of the nation, but nonetheless, cap rates are on the rise. More and more you see properties being discounted. And again, because the challenge is the interest rates. We went from the good days of 3.25% to now, say 5.75% to 6%. And that really does create turbulence for cash flow. Matt, if you can jump to the next slide regarding looking at the decades here. And I'm winding up for a question, Bruce, but I just want to give you some background on this.
I was just going to say something. You could Chris, you could create a moodometer for apartment values. All you'd have to do is say, okay, at a 3.5 cap, there's your value. At a 6 cap, that's the value. Because that's a mood change. That's what it is.
So this here looks at the sales volume and price per unit. This is the Eastern San Gabriel Valley. But it's, again, for those of you watching, whether you own in the Western San Gabriel Valley, the 605 corridor, 710 corridor, it's essentially the same. We went through all these at our live event, but we're using the Eastern San Gabriel Valley. So if you look at sales volume and then price per unit.
Okay. You see, I'm just going to interrupt. Okay. Isn't it wonderful? Look at how on sale they were in 2009 and 10. Right? Mm-hmm. I don't need to be an apartment ownership. I don't need to be an apartment expert to look at this chart and go, oh, I guess 2009 and 10, probably a good place to buy. And euphoria happened in 21 and 22. Right? Right. That's a good cheat sheet you got right there.
Well, and so here's the interesting thing. So obviously the 2 decades have mimicked each other. And in 2019, you walked in the room essentially telling the attendees at our event, hey, unemployment is low, homes are affordable, interest rates, while not as low as they would be in 2020, were nonetheless low. Why aren't homes selling? There's a problem in the market. Greg Burns walked into our event 2019 saying, hey, there's Greg Burns of IPX 1031 exchanges. They have a good sense of the volume that's taking place of money that's in exchanges. He's saying, hey, we're way down. I brought our own set of charts saying, look, If you look at price per unit, cap rate, we're cusping the hill here. But then in 2020, we got this anomaly that sent the market, it gave it one more gasp of air. But go to the next chart, Matt. But look at the fourth, this is by quarter now. Look at the fourth quarter in 2022. By then, interest rates had wreaked havoc on the market. We were hovering nearly 6%. Sales volume was way down at the end of last year. So that's what we want investors to know. So now,
okay,
interest rate.
Let's just park here for 1 second. I want you to look at fourth quarter 2021 and fourth quarter 2022. And then think about our unemployment number that's still at record lows. Well, guess what? For our industry, that's complete BS. So if in residential sales are down 45%, let's say prices are down 5%, the revenue created by our entire residential industry is down 50%. In other words, you could say there's 50% of the people making what they used to make, and 50% unemployment exists. That's what that really means. Now, they still are fully employed, apparently, because they have a license. But as a group, they're making half.
Right.
And that's what this chart is showing for the apartment world.
So in 2020, we got low interest rates and we had historical rental rates. Rental rates are already now slipping backwards. Interest rates obviously have gone up. The next challenge then would be vacancy. So this was a big windup, but here's a question for you, Bruce. So it just crossed my desk last week, and maybe I'm a latecomer, that the state of California is going to partner with homeowners and give them 20% of the property's value as down payment. It's the California Dream something or other. But essentially, first-time homeowner, they're going to give you 20% of the property's value. They're going to stay in business with you, and when you sell, you have to essentially pay the state back. But for landlords, for many of your tenants who they have good jobs, especially those, what areas you own in. You own in Pasadena, South Pasadena, Arcadia, Temple City, San Gabriel. They have good jobs. They just haven't been able to save the down payment because you've been doing a good job charging market rents. But now the state gives them 20% to put down on a home. First, with residential real estate, Bruce, what do you think that's going to do to the market? Is that only going to overinflate pricing for a minute and then create a greater pullback, or what do you think?
Wow. Well, I'd be really surprised if that just really hits a home run, as you are now partnering with a government entity. That I just don't know what percentage of people really get excited about that. So how long has this been in place? Right,
I felt the same way. It's they've announced it some time ago. They've been rolling out the information to the mortgage brokers and what have you, getting everyone prepped on the qualifications, because there's income qualifications per county. There's thresholds in terms of purchase price. But when I was looking at some of these, I mean, you're talking about they'll let you buy a house up to like $750,000 in some of these areas. So we're not talking about starter beater homes, $400,000 homes. They're allowing high limits. And my understanding is, as the buyer, because you're only really purchasing 80% of the house, you only have to qualify for 80% of the home's value. So in other words, that 20% is inflated because it's not your money, it's the state's money.
Right. Well, I mean, that seems like that would be supportive of price. How many people will do it? See, I think that's like a small counter to the bigger problem. So how you end up having price damage, at least in the past, is you have a motivated sale or a group of properties. In the past, it's been foreclosures. So that's doubtful this time. Mm-hmm. It's doubtful you're going to have a bunch of foreclosures. So who would be the motivated group of sellers? Maybe the unemployed. Unemployment may grow over the next number of years and create that. California certainly isn't building or overbuilding, but they used to. So in 2006, you completely overbuilt and you were stuck with a lot of inventory and auctions and so forth. You did the same thing in 89. This time you built 50, 60,000 homes, which represented 15% at the most of the whole group of sales. Okay. So that's a good question, Chris. I guess I always like to ask myself, would I do that? And the answer is no, I would not.
Well, you and I wouldn't, but think about this. Okay, so I've been trying to buy a new car for the last 6 months, and they tell you because of shortages or what have you, people are overbidding on new cars. So while we know it's not prudent to go into business with the state and allow them to put 20% down, well, it's also not prudent for some of these people that are paying $20,000-$30,000 over asking price on Escalades and Mercedes and BMW, yet they're doing it, right? Because consumer mentality. And so my point of bringing that up is, and I'll send you some information on this because it sounds like it's kind of new to you too, but it's a real thing. Mortgage brokers are rolling this out. They're getting the realtors prepped to know who qualifies. And I want to say the state allocated like $30 billion to, it's either 30 billion or 300. No, I think it's 30 billion. I'll get it to you. But I bring it up because of the vacancy factor. So again, landlords, rents are pulling back slightly, but pulling back. I wish I would have had the chart, but now for 5 months straight now, rents have pulled back. Interest rates are not helping cash flow, and it's pushing interest rates are pushing cap rates upwards. You're now seeing cap rates that began with a 5, something unheard of. And now what if we see an uptick in vacancy, meaning now we start talking about concessions, and we haven't seen concessions probably since 2012 in local areas where people were offering first months free and things like this. Not doom and gloom. I'm just trying to make people aware of what's the reality. Now, I'm going to take a question here from the crowd, Bruce. Someone asked, Mr. Simon here asked, Bruce, define a lost decade.
Where your prices, well, when you go back to that moodometer, you have lost decades, depending on the years you want to pick. So that's what I'm saying, is that you're going to have a decade where residential real estate doesn't hit its former high.
Now, because you have gone all in on Florida real estate, one participant asks, Bruce, are you not worried about rising groundwater, encroaching cesspools, mega storms, flood losses? What are your, the challenges that Florida has with regards to that?
No, the answer is no. And, I'm more of an independent study on stuff like that. So I know climate change is one of those scary subjects to even talk about. So if you're in the insurance world, I wonder why you can still get insurance with a waterfront property in Florida like I have. Since it's going to be underwater, and if I had a 30-year mortgage, I'd still be able to get a mortgage. So what's wrong with those people? So I guess I'm going to counter that. I would encourage you to read, just like I do in every subject matter. So if I'm going to write a chapter on oil, when I did that in 2006 for the crash report, I read 3 big fat books on oil. One said we're going to be out in about 10 years. One said we're never going to be out. And the one in the middle said we're going to create more with the resources we already have. So I would invite you to read not just the people that say this is going to be a catastrophe. I would listen to some of the other side. And here's what's really interesting about that. So this is really my honest opinion. There's a guy that started Greenpeace, and I'm sorry, I don't remember his name, but he was one of the starters in Greenpeace. And he's written a book. I'll probably have it on my phone here in a minute, so bear with me a second. Chris, this is true. when do you really know a speaker knows their stuff? When they do a canned presentation or it's Q&A?
Right.
Okay. So yeah, Q&A. So I would invite you to watch this guy do a presentation. And then every once in a while, he gets in front of an audience and does a Q&A or a debate. And the title book is, and again, I'm going to read this book whether I go for it or not. It's called Fake, Invisible Catastrophes and Threats of Doom, written by Patrick Moore. Patrick Moore knows more about this subject than I think anybody on the face of the planet. And good luck in a debate with him. And good luck showing him a chart that shows, oh, look at that, the temperature is raised in the last. Well, he'll point out and say, well, guess what? That chart is thousands of years long. So if you're going to blame that on the Industrial Revolution, that chart never better go up before the Industrial Revolution was around. And then he shows a chart that's very long and it goes up and down and up and down and up and down without Industrial Revolution. So I just don't listen, learn for yourself. Okay. So I find it interesting that an industry of lenders will loan you a 30-year mortgage in a waterfront property. Why would they do that if it's going to be 4 feet underwater here pretty soon?
Now, one of the participants corrected me. So I knew I was getting 300 from some. Okay, it's actually not 30 billion. It's 300 million.
300 million?
300 million.
Well, okay. Well, then let's do some division. Just for fun. They're going to put up 140 grand a house. Is that right? 20% of 700, let's say.
Mm-hmm.
Okay. So just figure how much that is. So in rough numbers, it's 7 per million times 300.
So you come, I don't have a calculator.
300 times 7, I think is your number. So it's 2,100 houses.
So I wonder if it's really the 300 million. So I have to get the answer to that, because it seems to me, obviously they did the math too. That's not very many people you're assisting.
Right. It's not enough to be a market changer. And that's why I wanted to get that number.
And we'll take a look at that.
Okay.
One person asked here, so if I don't want to wait more than a decade for the mood to change, I should sell my Los Angeles property. No, you just should be aware that you probably have a property that will likely not be worth what it was today. I write the California crash report in 2006. I had a residence in Riverside worth probably 1.2 at the time. So in 2006, when I wrote it, 1.2 million. Did I sell it? I sold it eventually for 750. So why would a guy write a report, sell 100 other houses and then not sell his residence? Because I don't own a residence because I wanted to make money. I own it because I want to call the shots inside my own walls. So I don't know how to answer the question. You know, am I selling any properties right now? No. But partly because I live in Florida, so there's a little bit difference, and there's a different set of numbers at work there. So we're still we've got 25 spec builds. Like I told you, I'm in escrow with 3 of them. The properties have gone up about 50% in the last 2 years, and every dollar of that has stuck. Those houses are pending for that exact number. I just sold my residence, and it had a 50% increase in 2 years, and every dollar of that stuck. So Florida is a different case because of who migrates here and how much money they have. And I know that at your session, you really dive into that. Of course, I've attended your live sessions, the one that you have coming up here in June. we only saw a handful of charts here of what you actually go through the day of. But like you said, Florida functions differently than California. Of course, we're losing wealth. We're losing a part of our population. For apartment owners, legislation only gets tighter and tighter. Mike Brennan, who you've met at our events, who's the eviction attorney, this last event basically said, landlords, you either are in or you're out, because it's only going to get more difficult. So if you can't, if you thought COVID was bad in the regulations, what's pending is worse. And so if you can't stomach that, then you probably got to contemplate an exit, because when it comes to the legislation and oversight and government interference, it's only going to get worse. Whereas in Florida, they're pro landlord, pro business, right? So it's a different animal altogether.
And that was part of the decision process I made to exit California, just because I didn't feel like I had control anymore. We used to, flip a lot of houses. And if I bought a house with a former owner in it who falsified a rental agreement, I could be a year taking them out of that. Last time I had to do it, it cost me $50,000 in legal fees.
With regards to the 1%, because I've been thinking about this as we've been discussing here, it seems to reason that with inflation being what it is, the Fed cannot pull back on interest rates. If anything, they only raised it a quarter point this last meeting, which it was not because there was economic strength. It actually showed the weakness of the economy and the banks. And so they would have liked to have raised it more, but had they pushed it past a quarter, it probably would have been an interesting ride at the banks and what have you. So I don't know that, how do we get to that 1% when the Fed is in a push come to shove with inflation, that, hey, they got to still continue to raise this rate because inflation is still a problem.
Well, that's the conundrum. They really are going to have to say, okay, we're going to go through the pain of a Volcker process. Doesn't have to be 17% interest to go through it. And I haven't decided which one they're going to do. I hope they land there. I do. Because then we'll hand off to our kids something that's maybe a chance for normalcy to occur. If you hand this market a 1% interest rates, so what's next? Are we going to replicate Japan? There's going to be a new chapter in this report having to do with, okay, this is the debt levels of Japan and the interest rates that exist. So yeah, there's some serious choices, and the longer we wait, there's sometimes not a lot of good choices, and that's kind of where we're at. So there's going to be pain someday, whether we decide to get it done now or we put it off yet again. Let me just ask you this. Let's bat this around a little bit. So let's say unemployment is going to be a lot higher within 6 to 12 months. And you still have inflation, or it's not gone away yet. Do you think the Fed lowers rates quickly, or they keep it going?
How did I explain to someone is they have the average consumer in one hand and business in the other, and they got to let go of one. They're not going to be able to hold both. With the battle with inflation, if they don't raise rates and they cave, then you might get hyperinflation. And so I think that they have to hold the line. Now, the problem is with next year being an election year.
That's right.
They're going to piece and glue this thing together I mean, look what's happening in New York right now. We won't name any names, but they'll do at any cost to win. So they're going to piece and paste this thing together. Tell the Fed, you hold the line, get us past the finish line. But it's like that rubber band, which if you keep pulling it, you don't make the hard decisions. Well, the further you get out, when you finally decide to let it go and it snaps back, it only hurts that much more.
That's right.
So, yeah,
well,
it's
to your point, one of the things that was really bad for 2006, 7, 8, and 9, 2006, 7, and 8, we had this artificially low affordability. It got down to 12%, which it had never approached that. And that's when I interviewed the lender and say, okay, well, that stated income question. Well, what happened there is we were at a low of affordability for 3 years when we did 500,000 houses. We buried 1.5 million buyers in a ridiculous price. You know how long it took to go from 22 to 17% affordability this time? 3 months.
Wow.
That's all we buried. 3 months of people with a fixed rate loan. So see, what's very interesting, there's a ratio. So I just did this chart for the first time, went way back and to the current. There's a ratio of what percentage of the market is new homes on an annual basis compared to existing inventory. So, I mean, it's usually, at a low, builders, say 2009, 10, they were building very little. Inventory was probably 12% new. And when you're at a market that's euphoria, you're about 21. So that's the spread. So you're counting on existing homes to fill the gap between 80 and 85% of the time. Well, one of the safeguards that's in place is those people have a mortgage rate that's 2 or 3 or 4. So would you exchange that for a 7?
Right.
You'd have to have a have to situation. Or you'd say, you know what, I got transferred or I lost my job and I'm going to go over here, but my interest rate's so cheap, I can make a cash flow rental. So all of this is uncharted territory, which was why the name of the last report was that. But,
Sorry,
but the longer you go, you're going to end up, first of all, just think about the volume of sales. The volume of sales now is about 250,000 instead of 400 or something. So any of those motivated groups that get larger start become a too big a percentage to ignore in how they affect price. So that's what over time you may have a larger group of people just have to make decisions.
Now, one of our attendees asks if they live here in California, they want to follow your example, say purchase properties in Florida. How hard is it, do you think, for them to manage at a distance?
Boy, that's a great question. Well, that's why, we actually force the California investors, I don't care if he owns 500 houses, to go through 2 days of understanding Florida market because it's a different animal. So anything from a distance is harder, man. You know that. So you build a team first. You go there and you build a trusted team. So I did this in Grand Junction, Colorado in the 80s. I literally door to door knocked every property manager and ended up with one that I stayed with the whole time I owned what I owned in Grand Junction, Colorado. And it was a game changer. If I hadn't chosen her, Mary Simpson was her name. How's that? That's a long time to remember that. But Mary Simpson was great. So yeah, it's a big deal.
Maybe one more question here. So this person brings up the point that when it comes to apartment loans, they're not fixed for 30. So
That's
to your
right.
point of, well, if you bought a house, or even like myself, I refied during COVID, I think my rate is below 3 on my personal residence. Why would I sell to now go get 7? Well, and to your second point of unless there's a need. So for those individuals, say if you bought an apartment in 2018, 17, 19, that era, you probably got a rate of about 3.5%. You're probably also tied, because all these loans are tied to indexes typically, you're either tied to LIBOR or one of the others. I would encourage those of you, if you don't know what index your loan is tied to, go pull out your note, find the index, because for LIBOR, for example, and I and Gil Figueroa, who you know from our events, the commercial loan broker, we walk through the math. LIBOR, by the time you take into what it's adjusted to today, the bank typically will say stack at least a couple points on top of that. You're now going to go overnight, in the blink of an eye, from 3.5% to 7% for somebody in that situation. CoStar, who we shared the article from earlier, shared an article a couple of weeks ago that you're already seeing issues in refinances when it comes to office space, medical space, because you cannot, given the new interest rates, these properties don't even re-qualify for their purchase price of even just a few years ago. So in the
Yeah.
apartment world, it's a different challenge.
Well, the office building that I just sold originally for $1 million. And I bought it for 319 and sold it for $1 million. The building behind me, I was in that building for closing in on 10 years. The building behind me was vacant for 9 of those 10 years. That's astonishing. But so you're right. That's one of the reasons I brought up the real estate agent. You have 50% of the transactions, the 50% of the income going on for lenders, escrow, insurance, agents. If you have a big real estate company, don't you think you're going to downsize like a whole lot?
Mm-hmm.
Well, that office owner, if he has a mortgage, maybe it's adjustable. And all of a sudden he's got a tenant that's taken up 25% of the space.
To my point, someone just put in the chat, my apartment loan jumped to 7.75%. So
okay.
it doesn't say where his starting rate was, but that is a world of difference. So again, apartment landlords, I want you to think about this. Those of you who maybe are challenging me saying, no, we're going to have 4 cap rates forever. If you sell a building at a 4 cap rate and you take debt at, let's say 6, your negative return on whatever amount the loan is, that's the problem. And that's why cap rates have been increasing closer to 5 now, depending on some certain, some exclusive areas, because the interest rates are a challenge. This individual, their loan just reset to 7.75. I don't know when they bought their building, but assumably it was during a time when cap rates were 4% or maybe, sub 4%. Now that interest rate, you're talking about a cash flow problem at that point.
Chris, you ought to replicate the cap rate chart over a long period of time, but then play with like a moodometer with the payment. So that you just said the apartment had this percent of mortgage and it just doubled. Well, let's say that you want to revert back to that payment. So the new buyer says, yeah, I want your apartment building, but I want that payment. What's that do to the value? That's
Right.
your new value coming up, whether it's here or not. And so that moodometer doesn't change overnight. It literally is it takes the temperature of the participant. So Chris, you still have people saying that, yeah, 4 cap forever. 2 years from now, the whole group could be saying something very different, right? So you're being really honest in saying this could be a game changer. What were cap rates in 80 to 85? It probably wasn't 4. It might not have been 8.
Right. Well, I have Matt. So I have the charts to that actually walk through this interest rate. I don't know that Matt will be able to pull up in time. We'll see if he does. But if we can, Joey, I want to give you control again. Let's put up your guys' slide for your June event, because I think it's important for people to be in attendance. Now, those of you watching, I don't earn a dime if you show up at Bruce's event. I don't get a referral fee. I've sat in on these events myself, paid for my ticket, even though I'm close friends with Bruce, because I think the information is that important. And while it is more geared towards residential real estate, understand people moving out of your buildings to buy homes or staying in your building because homes are not affordable has everything to do with apartments. That's why I think it's important. Okay, so here we go. So June 3rd, it's going to be in Riverside. Aside of, I see a number to call. Is there another way for people to get more information about the event? I imagine just go to your website, Bruce.
It's
Yeah.
easier if they email me a request. Just Joey at the Norris Group. It's in this side, and Chris, we'll give you a PDF version of this that you can go ahead and send out to anybody who participated today, so they'll have this information with them.
Okay, and it's a full day event, so it's worth the price of entry. I know they feed you there as well, but the information shared is just excellent information. So again, I encourage you, those viewing, to get there. Now, Matt, I don't know if you're able to pull up those interest rate charts here, because I think we can definitely finish with that, because I think it's to Bruce's point that we've already figured this out in terms of the cash flow. Let's see here. So I see Matt's going. Here we go. So Matt, you'll have to click along. So here's the impact of interest rates, Bruce. So I wanted to see.
I get it.
Right. So if you have $1 million building,
Yeah.
and we started out at 4.2 cap, and the interest rate was 4.5 at the time. Go ahead and click down just to the fourth line there, Matt. So by the time you get to 6%, your cash flow has dropped by 121%, simply by going from 4.5 to 6%. It went from 55.19 to negative 11.68. Now go to the next.
Okay. Do you now have a conversion that says, okay, I'll buy the building, but if I can get a cash flow of 55.19?
Here he goes.
All right.
Right here.
Love it.
So $1 million bill, same building, same income, 4.2 cap. Go down to the fifth line, Matt, just for the effect.
Yeah, there you go.
6%. In order to get the same 55.19 cash flow, you have to adjust the price by 121,000. Now the building's worth 878,000.
Now, okay. Now I want you to think about what also just occurred. Is your mood toward this investment as excited as it was 2 years ago?
Right.
So you're looking at 55.19 in euphoria mood. So what's really interesting, if you played with this going backwards, go to those years of 2005, 6, 7, 8, 9, all that. You go back to 2000. You'll hit euphoria to devastation to back to euphoria. You'll have the journey that you're about to go on. That's a fact.
Yeah, we'll have to dig into that. Thank you for the suggestion. So that will be coming up. We'll have that data for our next apartment owners educational luncheon set for sometime in the fall. And I hope you can be with us in the fall, Bruce. I know you would have been with us at our last event, but you had personal things to take care of. So hopefully in the fall, you'll be able to be with us. Again, those of you.
I sure want to be. Yes.
So, well, thank you, Bruce. You're always very generous with your time. I thank you for the information that you've shared this afternoon. Again, I encourage those of you viewing to get to Bruce's event. Any other closing thoughts, Bruce, before we let you go here?
You know, I want people to understand why you and I do business together. It's just because I respect who you are. I don't do anything in the apartment world. Matter of fact, I love attending your events because who's on the panel? They're all smarter than I am in the piece they have. And so I learn as much as anybody in the audience, and I'm glad that I get to share a piece. I'm the residential world, which is not a big piece of your audience, but because I have this little niche of timing. But I love how you do business, and that's why I've always been there for you.
No, well, I appreciate that, sir. Thank you so much. Thank you to those of you attending. For our other previous interviews with Bruce, he shares a ton of information or other interviews that we've had. You know where to find me on YouTube. Go to youtube.com/The Apartment Dealer, and I think there's nearly 200 hours there of educational content of speakers of Bruce's caliber in all facets of real estate, from legal, financial, and otherwise. I invite you to join us there. And until next time, this is Chris German, the Apartment Dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.